Okay, so hi everyone. Um, Now we're going to continue our lecture in income taxes. This is a lecture we started on Thursday, and the material of this lecture is chapter 12 in your textbook. So we stop here, and we're going to continue from this subject, in which now we're going to talk about income tax rates. So in terms of individual tax rates, there are 4 schedules or federal income tax rates for individuals. For the purpose of this lecture, we're going to focus only on 2 of them, which are the ones for single taxpayers and also for married couples taxpayers. So in this table, what we have is information that gives you a range in terms of the income of an individual taxpayer. So as you can see, these first 2 columns, the first range goes from 0 to $8,350, and from there you go to the next 4, and basically what those range do is based on those on your income, you're gonna find out in which range you belong, and that will give you a base tax and also will give you a percentage, and that information is used to compute the amount of taxes that you have to pay. And I'm going to show you how to use this information with an example. But in general, if you are within this range from 0 to $8,350, your base tax, the base tax that you're going to have to pay is 0, but you will have to pay a 10% of any income over $0. So if you make $1,000 a year, then you're going to have to pay 10% of that in taxes. And that applies also for the other ranges. So here is the information for married couples. Again, it basically follows the same format, but the numbers are different. And for instance, now the first range goes from 0 to 16,000, and again, you have a base tax rate of 0 plus 10% of any income that you made over $0. So let's look at this example. In this example, we have an unmarried student that earned $10,000 in the summer plus an additional $6,000 during the rest of the year. And when he files an income tax return, he will be allowed one exemption for himself. He estimates that he spent $1,000 on allowable itemized deductions, and the question is, how much income tax will he pay? So, as we explained in class, in order to get the amount of taxes you need to pay, you have to compute several things. The first thing you need is to get the adjusted gross income. So, let's find that. So, the adjusted gross income, in this case, we have that he earned $10,000 in the summer and $6,000 during the rest of the year. So the total is 10,000 plus 6,000, which will give you 16,000. Now, using the adjusted gross income, you can compute the taxable income. So you have taxable income, and that will be equal to the adjusted gross income minus deductions for one exception minus the standard deduction. Right? So we know that the adjusted gross income was $16,000. We know the deduction, the exercise is telling you that he will be allowed one exemption. So if you go back to one of the tables show you in class here, so we have for one exemption, this is the amount that was allowed for 2009, and also for the standard deduction, this is the amount. So we're going to use those two amounts to get our taxable income. So let's go back there. So this is going to be $16,000 minus $3,650 minus the standard deduction, and that taxable income will be $6,650. Okay? So now we have to take this information to find out in which range this amount of money is for an individual. So as you can see, that amount of money is within this range. So you know that your base tax is going to be 0. Plus you're going to have to pay 10% of those that income over 0. So in this case, the taxable income, so the federal income tax is going to be equal to 0 plus the 10% of that amount of money, which is over $0. So the federal income tax will be $665. Okay? So now I'm going to show you the information for corporate tax rates. So income tax for corporation is computed in a similar way for that of individuals. So again, what we have is a column with some range. So you have an upper bound and lower bound. And based on that, on your income or the income of the company, you have a tax rate or percentage. And you also have these windows in which we add a little bit more in terms of money depending on the income of the company. So if the income of the company was between $50,000 and $75,000, your tax rate is 25%, but you're going to have to pay $7,500 plus the 25% over that $50,000. Okay. So let's use that information to work with this example. So here we have a firm who bought a land for $220,000, had a $900,000 factory building there, and installed a $650,000 worth of chemical and packaging equipment. The plant was completed and operations began on April 1st. So the gross income for the calendar year was $450,000. Supplies and all operating expenses, excluding the capital expenditure, were $100,000. And the firm will use modified accelerated cost recovery system depreciation. So the first question is, what is the first year depreciation charge? So let's work with that. So letter 8. So we have chemical equipment is personal property. So chemical equipment is personal property. Which equals a 7-year all property class. And from table 11.2 from our previous lecture, depreciation, you can find the information for this type of equipment. So use table 11.2. So we're going to use a 7-year period for depreciation on the MACR method. And for the first year depreciation, so first year depreciation of the equipment that will be equal to that the cost of the equipment, which is $650,000, times that percentage, which is for the first year is 14.29%. So that means that the depreciation for the chemical equipment equals $92,885, and that's just for the first year. Okay? But we also have a depreciation related to the building. So the building was placed in service on April 1st. Okay, and that's information that is given by the problem. So from table, using table 11.4, we know that the first year depreciation for a building will be equal to the cost of that building and multiplied by the charge for the depreciation for that equipment based on the information on the table. So that's $16,371. Okay, so we have the depreciation for the equipment, the depreciation for the building, and we have an additional thing that we have to decide of what we're going to do with that. So there was a cost for the land, but what happened with the land? The land is non-depreciable. Okay, so we don't have to compute any depreciation for the land. Let me make that note here. Land, you don't have to compute any depreciation for that. So the total first year a CRS depreciation will be equal to $92,885 plus the $16,371, which is a total of $109,256. Okay, so this is the answer for the first part of the problem. So the second thing that the problem is asking is, what is the first year depreciation income? So I'm going to work with that on the next slide. So to get that, again, you need to find out what is the taxable income. And that will be equal to the gross income minus all expenses except capital expenditure minus the depreciation charges so that will be equal to your taxable income. So you have a gross income of $450,000. You're going to subtract our expenses except the capital expenditures. So we have $100,000 for that, minus the depreciation charges for the first year. We know that that was $109,256. So in total, the taxable income will be $240,744. Okay. The last question is, how much will the corporation pay in federal income taxes for the year? So for that, we need this amount. Now we have to refer to the table for corporations. And you know that the range was about $200,000. So that range belongs, or that amount belongs to this range. So you're going to have to pay $22,250 plus 39% over the $100,000 in corporate income tax. So let's go back here. So for letter C, we have $22,250 plus 39% times your taxable income. And that will be equal to $77,140. Okay. So this is what we have done so far. We talk about income taxes for individuals. You saw how to use the information to compute the tax that you have to pay to the government. And we also did the same thing for corporations. Okay. Now, using this that we know, we're going to use the information for depreciation, the information for income taxes, and now we're going to perform economic analysis taking that into account. Okay. So economic analysis taking into account income taxes. An important step in economic analysis has been to resolve the consequences of alternative into cash flow. So we take the information we have and we try to put that information in terms of cash flows. But because income taxes have been ignored, the result has been a before tax cash flow. So far we haven't included the information about income taxes, depreciation, inflation. and so on. But at this point, we are now adding the information about income taxes. So the principal elements in an after-tax analysis are as follows. So you will need to have the before-tax cash flow. So that's what we have computed for our exercises up to now. But we are going to add the depreciation, and using the depreciation, we're going to compute the taxable income, and that will provide us with the income taxes. So now we're going to be able to get an after-tax cash flow for our analysis. Okay, so up to last time, we were computing and solving problems for before-tax cash flows. Now we're going to add this information, and we're going to compute an after-tax cash flow. So let's look at one example. So here we have a medium-sized profitable corporation may buy a 3,000 used pickup truck for use by the shipping and receiving department. During the truck's 5-year useful life, it is estimated that the firm will save $800 per year after all the costs of owning and operating the truck have been paid. The truck salvage value is estimated at $750. So we have these amounts, $3,000 that they pay for the truck, $800 that are going to be saved per year, and we have the truck salvage value, which is $750. So the first question is asking you to compute the before tax rate of return. So we know how to get the rate of return for any type of problems. So let's work with that. So let me draw the cash flow diagram first. So for this problem, we have an initial investment of minus $3,000, and then we have some savings for a 5-year period. So 1, 2, 3, 4, and 5. And we also have a salvage value of $750. Okay, so that's how the cash flow diagram looks like for this problem. And the question is asking for the before tax rate of return. So for the rate of return, we're going to use the present world. We're going to get the cash flows to the present, and we're going to equal that to 0. And we're going to solve in terms of the interest rate. So we have an initial investment of $3,000 plus the annuities, which are $800, and those are savings, so we're going to use a positive sign. We're going to bring that to the present, so we use a P given A factor. The interest rate is unknown, and this is a 5-year investment, plus the salvage value. We're going to bring that to the present from the future. Interest rate in 5 years. And all this equal to 0. So again, this is the present world. And if you solve this, and we have discussed different ways of solving this, interpolation, using tables, and so on, you will get that the interest rate equals 15.7%. Okay? So that's our before tax rate of return. Now, part B of the problem is asking what is the after-tax rate of return of this capital expenditure. And you're going to have to use straight line depreciation to get that after-tax depreciation. So let's work with the depreciation first. So this is part B. part A. So the depreciation schedule based on straight line. So you know for straight line you need the initial cost that's minus the salvage value divided by the number of years. So in this case we have an initial cost of 3,000 minus the salvage value, which is 750 divided by the number of years, which is 5. So this is going to be equal to $450 per year. Okay? And now, using these depreciation, we're going to create an after-tax cash flow table. So, create after-tax cash flow table. And that is shown in the next slide. Okay? So we're going to assume that for a medium-sized profitable corporation, the income tax rate of return is 34%. So let me make that note here. So for a medium-sized corporation, assume an income tax rate of 34%. Okay? So that information will allow us to get the after-tax cash flow. So let's start from the left to the right. So here we have the years. So per year we're going to compute the cash flow. So for year 0 you make the investment of buying the truck. Then you have some savings for the 5 years. And then you also have the salvage value for that truck. We get the information from the straight line depreciation, so you know that you're going to depreciate $450 per year. So the taxable income will be the difference between your cash flow and the straight line depreciation. So if you subtract $800 minus the 450 for the depreciation, that will give you that taxable income per year. So it's the same amount for this 5-year period. And now you have to apply that income tax of 34% to the taxable income. So if you multiply these $350 times the 34%, that will give you this amount, $119. And the amount is the same for the 5-year time period. So your after-tax cash flow basically is going to use this information, which is your income tax, and this information to get the after-tax cash flow. So if you subtract $119 from 800, that will give you this amount. And that is your after-tax cash flow. Okay? Okay, so let's talk about capital gains and losses for non-depreciated assets. Okay, so this is, I believe this is the last topic in this lecture. And again, capital gains and losses for non-depreciated assets. If the selling price of the capital asset exceeds the original cost basis, then we call this capital gain. If the selling price of the capital asset is less than the original cost basis, then there is a difference. That's called a capital loss. And we basically name those cash flows depending on the result we get with the difference between the selling price and the original cost basis. So if you have a capital gain, then you're going to apply a specific type of taxes to that. If you have a capital loss, you're going to use a different type of taxes. So this table basically lists the tax treatment of capital gains and losses. So for individuals, if you have a capital gain, for most assets held for less than a year, taxes are ordinary income. But for most assets held for more than a year, then they are taxed for a 15% tax rate. If you have a capital loss, then you subtract the capital losses from any capital gain, and the balance may be deducted from ordinary income, but not for more than $3,000 per year. Excess capital losses may be carried forward indefinitely. For corporation, a capital gain is taxed as ordinary income. Capital loss is you deduct the capital losses only to the extent of the capital gains. Also, excess capital losses may be carried back 2 years, and if not completely absorbed, is then carried forward for up to 20 years. Okay? So, as a summary, we talk about income taxes in this lecture. We talk about how to calculate the taxable income. We talk about how those tables for income tax rates are used to compute the taxes that you need to pay to the government. And we also talk about how to use that information in our economic analysis. The last thing we did was to mention what are capital gains and losses for non-depreciated assets and how those gains or losses are taxed. How do you apply taxes to those gains or losses? Okay, so essentially that concludes the lecture for income taxes. We're going to have a homework that is going to include some problems from this lecture and also problems for depreciation topic, and that's going to be due on Thursday next week. Okay, so